We'll show you a wall element that we made to really give you the full extent of the quote. Here is the Cleveland Fed president, Loretta Mester. This was last night in New York, suggesting that rates need to go above 5. This is the old higher for longer.
Right.
So apparently she doesn't think that the events around SVB were as disinflationary, perhaps, as Joe suggests they were.
Yeah, well, I'm not sure what other data she's looking at, because if you look at rents, we know that those rents are coming down fast. There are other disinflationary factors in the market. Just think about what we were so worried about 6 months ago. We were at 8%, 9%. And, now we're looking at jobs being weak, wages are up, but not at the same level. You've seen it in office workers. While services are strong, services will follow the rest of the economy, and that's bound to be weak at some point. So she must be looking at something else, or perhaps she's just posturing, perhaps because she thinks, don't let people ease up. Don't let people start to think that we're going to let them off the hook. But I still think that it's unlikely that they can keep these rates up this high if we have an economy that's definitely slowing.
So, Bryn, what do you want to make of the data today juxtaposed against Mester?
I think the data is telling us what we already knew, and that data doesn't even remotely reflect to Joe's point, the disinflation that's coming from the regional banks, lack of lending, that will absolutely happen. And I think where Mester, there has to be so many assumptions that she's making. If I take a step back, though, and look at historically, the Fed has never stopped a tightening cycle before CPI was below Fed funds. So right now, CPI is around 6, Fed funds is at 480. If you just go back and look, March of last year, May and June, those CPI prints, Scott, were 1 to 1.2. As those start to roll off, and even if we grow at 0.4 over the next few months, by June of this year, CPI will be about 3.6%, well below where Fed funds are. And so I think that she is, to Carrie's point, also posturing with tons of assumptions. But all of the data is telling us inflation's coming down. Atlanta GDP says year-end real GDP should be around 1.8. And so I think this is where we get into that playbook that the Fed always over-tightens. And so it's not really, the history is telling us that it probably won't be that different again this time around.
Utilities up, staples up, your gold up, your GLD. That's proven a good place to be, as this week was, one of those points where we mark and say, okay, gold got back above $2,000, first time in a year or so. Or, are those the trade? If yields are coming down, utilities, you want to be there. If you're more worried about where we are, staples, do you want to be there? Gold, do you still want to be there?
Yes, you do, because there is a large disinflationary effect that's right now impacting markets. Clearly, the economic conditions are going to weaken. And just back to the Federal Reserve for one moment, they see what's going on in the economy. They realize that there's $5.1 trillion sitting in money markets. The offset to that is that the entity that is offering that yield is parking their capital at the Federal Reserve. Why? Because in a reverse repo, you get 4.8%. So right now there's $2.3 trillion sitting in those reverse repos. That means there's no lending. So the consumer's sitting there with a higher interest expense, tightening credit conditions, and guess what? In the last couple of days, now they have to worry about an oil expense.
Yeah, I want you to address what I asked you. Do you want to stay in utilities and staples in gold?
Gold,
or
yes.
do you want to buy the dip in tech? Because tech's been down for a few days.
Okay, so
that's what I want to know.
You're asking someone who, like the overwhelming consensus, came into the year with the institutional positioning underweight technology.
Right.
Now you're moving towards the end of a quarter where there's been a change in economic conditions that lends itself towards what? Growth is back. Technology is back. So at the end of this month, I'll sit with you. I'll tell you exactly what I'm doing strategically within the portfolio. But you have to acknowledge that being underweight technology and growth, that hasn't been such a good strategic positioning this quarter.
So Kerry, I'll give you the same question. Joe is obviously limited by the parameters of the rebalance to some respects. I get it. I get it to some degree. And I know he can't say that much because he's got positions that he has to perhaps rebalance and change within the structure of the Joe T ETF. You don't.
No.
So utilities, staples, gold, what's working today? Remember, yesterday was a bad day for the cyclicals, industrials, energy, materials.
Right.
Technology's been down for a few days.
Yep.
Not by that much, but nonetheless selling off. NASDAQ's down near 1.5%. NVIDIA's down 3.25% at this moment. Do you want to buy the dip in tech?